Well, hello, everybody. Hello, everyone, and welcome to Hard Money Jim at the Ayn Rand Center UK YouTube channel. I'm speaking today once again from beautiful Coronado, California. I wanted to mention something before I get started. The pandemic here is largely over, but I wanted to acknowledge a local politician here in a positive way. As you may know, our dear leader, Governor Gavin Newsom, attempted to enact some of the strictest masking rules in the country. And by now, of course, all of us know these are ridiculous. But to his credit, our mayor here in Little Coronado, California, a man named Richard Bailey, just said no. He said, I refuse to enforce these mask mandates. Now, he just made Little Coronado, California, a little island of freedom. This is an island city, a little island of freedom right in California, right in the People's Republic. So that was inspiring to me. It encouraged me. Perhaps it does to you. You feel that way too. So here's a shout out to Coronado Mayor Richard Bailey for that courageous stance. Okay. All right. Well, let me share my screen here and we'll get underway. Before we dive into today's discussion, I want to remind you why I have taken up this project of writing on Substack and broadcasting on ARC UK. I was a banking analyst for years at a large asset management firm. And during those years, I came to realize that very few people, including myself, really understood why the money supply always grows, what money is, at least what we call money today, really is, and how it's created. And then over the years, I began to understand how important and poorly understood this issue is. Very bright people at my firm didn't understand it. And I don't think I did fully either. And so the reason it's so important is that money creation is mostly caused and manipulated and directed by our government. It's used as a political tool, a tool of crony capitalism, and essentially a tool of government force without most of us realizing it. Now, that's in addition to its very good and noble uses. But it's got some uses by government that are not very positive. So I decided to understand money creation and its consequences much more deeply and make a long-term study of it, and then to share that information with anyone who will listen. And my hope in this project is that I and you will increase our understanding of the nature of money. And by doing that, perhaps we can become better defensive investors by avoiding the wrecks that are caused by government money creation. And hopefully we can appoint better politicians who are committed to sound money and therefore a safer and more secure economic future. So that's why I do this. Everything I comment on has a close relationship to money creation and its consequences. And I would hope that both you and I always keep that context in mind on these broadcasts. Okay, so today, our main topic is to show concretely that inflation is caused by money creation. But before we do, I want to follow up with a couple of things from previous broadcasts. First, let's do an update. We're going to make this go here. Yeah, an update on banking sanctions, which we covered last week in some detail. The update is simply this: the sanctions are not working. And I'll give you 2 data points. First, the banking sanctions were supposed to wreck and crush the Russian ruble. President Biden boastfully, boasted repeatedly about this. He said he would crush the ruble and wreck the Russian economy. Well, here's a chart of the Russian ruble exchange rate versus the dollar, and you can see that its price has completely recovered. And this is probably due to several factors. Well, first of all, the banking sanctions are incomplete because not all of the dollar-based banks that trade with Russia have in fact been sanctioned. In other words, some of these banking sanctions turned out to be Swiss cheese, just full of holes. Russian access to dollars is restricted at some banks, but it's not completely closed off. And second, Russia has been able to get around these sanctions physically by moving its oil on longer journeys and stopping at different ports and disguising the ownership of its oil. You have to remember, oil is a fungible liquid commodity, no pun intended, and it turns out in some cases it's hard to tell where it comes from without severe scrutiny. And meanwhile, the plan for alternative payment systems, such as the Chinese paying their currency for oil and Russia paying their currency for oil, both from Saudi Arabia, those continue to move forward. Now, here is a quote from a Bloomberg article a couple of days ago. Russia's crude oil exports, a key source of revenue for Vladimir Putin's regime, are showing no signs that they are starting to crumble amid the disappearance of European buyers. Shipments in the 7 days to April continued, a rebound that began the previous week after consistently falling since Russia's invasion. Let's just go real quick here to the Bloomberg article, because it was I wanted to show you these. These are crude flows from Russian seaborne crude flows. You can see they have completely recovered. Here are another look at it. Export receipts, setting new records. And what's happened, if you look in detail down the article, what's happening is that Russia is exporting less to countries like Germany and more to countries like Asia and China, or countries like India and China. And by one report I read, Russia's daily exports of crude are actually down maybe 4 or 5%, but that is mostly from the voluntary self-sanctions of the private businesses that are refusing to buy, not from financial sanctions. There's a refusal to buy the physical goods, not sanctions on the type of money being used to pay for the goods, is the only thing that's working, and that not to a very big extent. Now, again, how is this sanction issue related to my constant theme of fiat money creation or system of pure credit creation? Why do I talk about it? Because if you'll recall last time, the main reason government thinks that it can even impose financial sanctions is that government controls the banks which create and transfer the money that we call dollars. Money today exists mostly at the pleasure of the government. If money was still a voluntary market-based phenomenon, like gold, then financial sanctions would really not even be much of an option for government. Despite the fact that government is the controller of money, these sanctions are still apparently not working because Russia has an important product to sell that will always find a market. That's oil. Notice that government financial sanctions, though, are an option, and they do work. Bank sanctions work when they're directed against weaker targets, like individual citizens who are basically helpless. And we saw examples of that last week in the operation, when I talked about Operation Choke Point, and in Justin Trudeau's shutdown of the truckers' bank accounts. Notice also, ironically, that the sanctions that are working against Russia appear to be voluntary sanctions, in which companies just voluntarily stop doing business. So it's basically the voluntary market-based sanctions that are working, to the extent any are. And even though our government controls the creation of movement of dollars, they still can't cut off Russian oil, which is a valuable commodity, and it's always going to find a market. I mean, they say you can't fool Mother Nature, but I say you can't fool Mother Market. for kind of similar reasons. Anyway, that's an update on the failing bank sanctions. All right, so next, let's update there we go. Let's update the consumer price index. You probably heard Consumer Price Index jumped 8.5% year over year as of the end of March. And that was its highest annual growth since December 1981. A large part of this rise came from higher energy prices. The energy category of CPI rose by 11%, its second fastest monthly rise on record. Only from Hurricane Katrina in 2005 do we see a faster one-time spike. So energy prices can swing wildly from one month to the next, but things like housing prices, which are a far more stable component of the CPI, also continue to rise. On a 6-month annualized basis, owner's equivalent rent has risen 5.3%. And as I've explained in previous broadcasts, it's going to go higher. It has to. Rents have gone up even faster. These are actual reported rents at 5.6%. Rent of primary residence has notched its highest 6-month annualized change since August of 1986. Okay, next. I love this chart. This shows the more volatile or flexible components of the consumer price index. This one does not include food and energy. And you can see that these items are rising 20% year over year. If you included food and energy in this chart, the number would be 23% annually. Now, these numbers are mostly not related to housing or shelter or utilities, which are the more sticky prices. The rate of increase on these volatile kind of prices, may be peaking at least temporarily. Let's hope so, but I don't know for sure, and I won't claim to know. But even if the rate increase does relax a little bit, or even a fair amount, we are certainly in for higher inflation for months and more likely for years to come. Because even if the annual consumer price index rate backs off to say 5% by the end of this year, that's still a big problem for the Fed and still a big problem for the administration. So expect it to be to remain a political problem. Okay, so that is an inflation update. But before I move on to the main event, explaining which I hope will explain the main cause of these price index increases that we're seeing, I want to recommend a new inflation measure that I just discovered like day before yesterday. And it comes out of an excellent research effort from the University of Pennsylvania. This measure is called Trueflation, and you can get it on the internet at app.trueflation.com. That's app.trueflation.com. Now, what this does is adopts the same consumer price index categories as the Bureau of Labor Statistics does, but it updates these numbers with actually observed prices in real time, no lags, and it does not rely on judgmental surveys like how much do you think your owned home would rent for. It takes actual observed data, and so if I can figure out how to. Oops, sorry about that. I wanted to get to this trueflation.com. I can't seem to find my mouse. But anyway, so I'll skip that. But what you should go to it yourself and guess what you think the Trueflation measure of the CPI is today. Would you guess? 13.5%. Go look for yourself. I think you'll enjoy this site. Okay, Daniel, should we pause for a quick super chat update here? Is there any questions or anything that people have before I go into the main event?
Yes, we have two super chats. One from Bonnie Bernard for $2. Thank you. And she says, one of the ARCUK's best shows. Thank you, Jim.
Oh, okay. Thank you, Bonnie. I appreciate that. Appreciate the donation.
And we also have a super chat from Marvin K for £2. Thank you very much. And he just sends a sticker with cool sign.
£2. You know where that measurement standard came from. It used to be 2 pounds of silver. That was a pound of silver was just a pound. That's where it came from. It was hard money. Okay, thank you very much for that, for your support. All right, so we see these soaring prices, but what's the cause of them? What's the cause of the soaring prices? Now, the Biden administration continues to blame it on poor, I won't say poor, bad old Vladimir Putin. These are Putin's gas prices, he says. These are Putin's food prices. And he says, and even pundits on the left, his normal allies, are calling him out on this because they know prices were rising well before the Ukraine war started. In general, politicians and bureaucrats are in complete denial about the cause of inflation. You will not get the truth from them. For years, since about 2009, the annual rate of increase on the US CPI has been about 2% or slightly lower than 2%. And all that time, the Fed kept saying it was struggling to reach 2% CPI growth. And they began to think, apparently, that no matter how much money they created, they could not raise consumer prices. In the first quarter of 2021, for example, the Fed was still complaining that it could not achieve 2% inflation, which for some reason it considers optimum, for growth, for economic growth. But then next, when the CPI inflation first boiled up in the second quarter of 2021, the Fed said it was transitory, which means temporary, which by that they meant just a price rebound from pent-up demand, coming off the depressed levels of the pandemic. Then when prices hotted up in July of 2021, the Biden administration and most of the media blamed these higher prices on product supply shortages caused by the pandemic. And then when prices went up even more in the fall of 2021, they blamed it on supply chain problems. And now that we have a war in Europe, they're blaming Vladimir Putin because of further supply disruptions, mostly on oil and pretty soon on wheat. Now, since the Fed, and not the Fed nor the politicians or any of these people could foresee any of this, I think we're entitled to be skeptical when people like Jen Psaki or some other spokespeople tell us that price increases are soon going to moderate. Maybe they will. Excuse me, but one thing we do know is that the Fed and the administration don't know. They didn't see this coming, and I maintain they don't have a clue now. They don't know what they're doing, and they refuse to acknowledge responsibility for these very disruptive price increases. Because all this time, the elephant in the room, the one thing they don't want to talk about, except sometimes you get an occasional Republican politician talking about it a little bit. The one thing they don't want to talk about is the massive government stimulus spending that was financed with quantitative easing. By this time, you're probably tired of seeing my favorite chart. Remember that what the US Congress and the administration did was they passed stimulus legislation that they could not pay for in tax revenues. In 2020 and 2021, the US government's combined deficit totaled, for both years running, totaled $5.9 trillion. Now that was government spending not paid for by citizens' taxes or fees. In other words, not paid for by actual revenue. The actual deficits were 3.1 trillion in 2020 and 2.8 trillion in 2021. And in that same 2-year period, the Fed and the banking system monetized or purchased, using new made-up money, a net of $6.3 trillion in Treasury and mortgage-backed securities. In other words, the Fed took $6.3 trillion in bonds out of the economy and replaced it with $6.3 trillion of new spendable money. And this means that the entire unprecedentedly huge deficit, and actually even more of it, was paid for with new money. Some say printed money. The government injected 6.3 trillion of new money. And so the 5.9 trillion deficit was government spending that was only made possible because there was new money that never existed before to spend. So let me appeal to your common sense here. This $6.3 trillion increased the US money supply by 40% in only 2 years. How could this not be inflationary? How does this massive infusion of cash into the public and into the investment markets not explain the rise in the stock market, which was up 70%, the rise in house prices, which was up 30%, and now this big rise in consumer prices that we're seeing? If you shower $6.3 trillion of new money on people, increasing total cash by 40%, are they not going to spend it, or at least spend some of it? You can do the math. $6.3 trillion is about $19,000 for every man, woman, and child in America. Now, of course, this was not really helicopter money in the sense that everybody got the same, because we didn't all get an equal amount. Some got a little, some got a lot, and frankly, some got nothing. Looked at another way, though, here in this chart is some nifty data from the Fed. Household bank deposits, those are non-business bank deposits in the USA, went from just under 400 billion before the pandemic to 2.6 trillion in 2 years. Now, I acknowledge that disruptions in supply and shortages from the Ukraine war do have an effect on prices. Of course they do. But supply disruptions of some or a few types of products cannot explain the across-the-board price increases in every single category of spending, from commodities to house prices to consumer goods. Because under normal circumstances, if you think about it, all of us only have a specific amount of money to spend. For the price of, any one or two things to rise, one of two things has to happen. Either the supply declines or the demand increases. If people spend more on food, driving food prices up, they have less to spend on gas or clothing, which would tend to drive those prices down. That's the nature of prices. Unless, of course, they have more money to spend on everything. Okay, now, I want to, at the risk of doing a little math here, I want to go into supply and demand and pricing and sort of prove this up to you. The price of anything can be expressed by a simple expression of supply and demand. This is the so-called equation of exchange. Demand equals average price times supply demanded. And the same equation written differently is just average price equals total demand divided by the quantity demanded. Okay, so easier when you look at it than when you speak it. So for example, just to make it real, if customers spend or demanded $2,000 worth of cigars at my local cigar store, and they bought with that $2,000 200 cigars, the average price per cigar was $10. That's $2,000 spent divided by 200 cigars sold. If the supply went down to 100 cigars and the customer still spent $2,000, the average price per cigar would be $20. And if demand went up to 3,000 on a supply of 200 cigars, the price per cigar would be $3,000 divided by 200 cigars, or $15 per cigar, and so on. You get the idea. So we can extend this same idea to an entire economy where many, many products are exchanged. We can use GDP as a proxy for demand. And then to know where prices are going, we need some proxy for supply. That's physical goods and services to get a general price level. Well, the US government gives us all that information. As a proxy for demand, we have nominal GDP. That's not what's shown here. Nominal GDP, which is just the total spending for goods and services. Then we have real GDP, which is shown here, which is just nominal GDP reduced by a price index. That's the price index that's similar to the CPI, and that's called a price deflator. But here's a graph of real GDP from the Fed. And what it's telling us is real goods and services consumed took a dive at the beginning of the pandemic, but then they recovered to previous levels in just 1 year. And by 2 years, they set an all-time high. What that line on the far right is telling us is we consumed an all-time high amount of physical goods and services, of stuff. So using the government's own numbers, as reported by the Fed, I did the easy calculation. I calculated that nominal GDP, or overall demand, went up by 10.6%. At the same time, real GDP, that's nominal GDP corrected for price increases, went up by 3.15% over this 2-year period. That means that overall demand measured in dollars went up over 10%, while the supply of goods went up by about 3%. Now, if you look back at the equation, price equals demand over supply. If the demand D goes up by 10%, while supply S goes down by 3%, what will happen to P, price? Well, prices will go up by 1.1 plus 10.6%, 1.106, divided by 1.0315, or about 7.26%. That's the pricing, that's the average price increase that you can calculate from these numbers. Now consider the current CPI increase, which is way up, based on the real GDP data here. Does it appear to you that the price increase was due to a shortfall in supply? Or was it because of an outsized increase in demand? If the supply of goods and services had actually declined because of lockdowns or pandemics or whatever, we should have seen this in a smaller GDP number. But real GDP increased. It didn't decrease. We produced and consumed more. So the price increase had to come from increased demand, an increased demand greater than the increase in supply. And where did that demand come from? More spending. By definition, it came from more spending. Where did the money from more spending come from? Certainly not from people's savings accounts. There's only one answer. It came from the new money that we know was pumped into the economy by the government. Now, it may seem obvious to you that adding money to the economy will increase demand and increase average prices. But many economists actually doubt this. Statistically, they don't see a perfect one-to-one ratio between the measured increase in money supply and the measurements increases in prices like CPI. So they just assume there's no relationship. But there is a strong relationship between money supply and spending or demand. It just doesn't occur immediately or in perfect proportion. So I now want to share with you some interesting data. A really nice squiggly chart here, but you have to look at it closely. And this comes from an interesting new paper I ran across recently. And it came from an investment advisor named Lynn Alden, Lyn Alden, Alden. And if you're looking for, by the way, if you're looking for an excellent source of advice for your personal investments and investment education, I recommend Lynn Alden. She's really quite good. Good writer, very, very clear thinker. And she can be easily found on the internet. Anyway, this is the supply of money supply and CPI inflation. And this chart shows a rolling 5-year percentage growth in broad money supply. That's the blue line. What the Fed calls the money supply being what the Fed calls M2 or broad money. And it calculates it on a per capita basis. And then it overlays that with a rolling 5-year percentage increase in the consumer price index. I don't want to get too technical here, but money supply here is calculated per capita because the population level is a proxy for basically for productivity. The more people there are, the more an economy can produce. And if money growth exceeds productivity, you'll get price inflation. So I'd argue that the money supply per capita all by itself is a pretty good measure of inflation. But then the question is that thesis, that very thesis there, that the money supply per capita is a good measure, is that confirmed by price increases? And you can see that this is generally the case. So if you look at around the turn of the century, you see an increase in money supply proceeding by quite a bit, an increase in prices. And then again, you see it in the 40s. And then again, you see it in the 60s and 70s. And then you fast forward now to the blue line on the far right, where you see a big spike in the money supply, which is up over a 5-year period now about 50%, a level that before has given us very significant prolonged inflation. Now, I can't guarantee that this is going to repeat again, but I would bet on it rather than against it. The main thing about this chart, I would say, is that many economists claim there's no direct relationship between money supply and prices. And I would say, on the contrary, that the main determinant, not the only determinant, of a general price level is the overall demand for goods. And the main determinant of demand is the amount of money in existence. So the supply of money rising faster than the supply of goods and services will, all else equal, cause the general level of prices to rise with a lag over time. And this chart is generally consistent with that thesis. Now, you can visit this chart yourself if you want. Back up here. You can go to visualcapitalist.com. There's a much better, very good interactive chart there. If I could find my mouse, I would go right to it. But anyway, so go to it, and it's a very good chart, and it's very well displayed, and I recommend it. Visualcapitalist.com. So where's all this going? Why is this? How high the CPI goes, whether it's 8% or 10% or 15%, is not, in my opinion, particularly critical or important, except for the possibility that a high number, like say 10 or 12%, if we get there, might induce panic in an already panicky government, and it might encourage them to, quote, do something. The first thing the government might do is that the Fed is now, I think, definitely going to fight this inflation. And they'll fight it by killing demand. They'll fight it by doing the opposite of what they did when they printed money, which of course increased demand. Now they'll have to rein back on their money growth and rein back and on the bond buying and increase interest rates in order to kill demand in the economy. And then that means they have to do damage to an already unhealthy economy in order to rein in demand and reduce prices. And the risk, of course, is that they cause more economic pain than they alleviate. And in fact, I think they already made their big mistake by providing way too much stimulus. And my belief is that there's now no way that they can calm down consumer inflation without seriously damaging a lot of people in a lot of industries. And so I want to go into that aspect of what the Fed is going to do in detail next time, but I'm waiting on some data to make it a better presentation. So anyway, that is the first reason I'm interested in the CPI numbers, because it's an indication. The fact that these CPI numbers have moved very high, very fast is a good indication of the seriousness of the problem we have as the Fed sees it and the likely strong reaction that they will take. Okay. Unfortunately, economic misery is the only solution. It's the Fed's only solution to inflation. And the worse the inflation, the more misery they have to impose. So, again, I'll go to that. I'm going to table that discussion until next time, because I want to go into that next time in more depth. But the second reason I'm so interested in watching the CPI level is that these CPI numbers are now also a bellwether as to what the administration is likely to do from the side of regulation and presidential executive orders. If we get double-digit inflation, the pressure on President Biden to do something, which is already enormous, it'll just be too much. I think he'll feel he has to take action, and I suspect that action will be price controls or rationing or subsidies of some kind, all of which would undermine the recovery of the proper balance between supply and demand. So, I love this little cartoon. Is there a history of mental illness in your family? I have a cousin who thinks inflation is Putin's fault. I think we'll get more insane thinking. What can you expect from insane thinking? What will be the target or targets for price controls? Your imagination is as good as mine. So maybe Biden will continue to blame high prices on Putin, and then maybe he'll take some emergency wartime-related price control measures. My best guess is that any such controls would be concentrated in the categories where people are hurting the most. So look to where there's the most publicity, most public awareness. So look to the typical victims of inflation, the working poor, minorities, and so forth, and look to their most visible cost categories. So, for example, affordable housing is already an issue, and shelter costs are already rising and will continue to rise. So perhaps we'll see some new controls or subsidies on rental costs, or some kind of affordable housing initiative. Or you can watch gasoline prices, which is always a favorite on the nightly news. Although nowadays the administration might spin high gas prices as a positive climate thing if people are going to drive less. But then there's the potential initiatives on controlling food prices for people who are thought to be priced out of the market. I hope all this is wrong. I hope we don't get price controls, but I do expect it. Okay, so that's inflation update. Daniel, before I just do a few closing lines, do we have any other questions or comments?
Yes, we have 3 more super chats. The first one is from Kirk Wilcox. Thank you for $2. And he says, thank you for the informative videos, Jim.
Oh, well, thank you for the thank you. I've started to put these out on my Substack channel, and I was surprised. I got some very positive comments, and so I appreciate that, Kurt.
We have another one from Free Trade. That's 50 Swedish krona. Thank you for that. And he says, wow, the stock market chart looks suspiciously similar to the money supply chart.
Oh, yes. If you deflate, it's interesting, if you deflate the stock market, for CPI or deflate it for the gold price, it looks pretty flat. It doesn't look all that great. Stock market in general, I think you probably will have made big money in some very specific stocks if you've been in the stock market, at least, inflation beating money.
And
go ahead.
We have one more super chat from Enric Teller for $2. Thank you for that. And he says, thank you for the economic knowledge.
Oh, well, believe me, I feel like an ignoramus sometimes. It's hard won. It's not that complicated, but I don't think the actual concepts are complicated. What I think is getting the data and looking at the relevant data amidst all the noise and the sort of the static is the tricky part. And I believe I learned a little bit about that during a 35-year investment career, trying to pick out the good information on, picking good industries or good stocks that had a positive future. But anyway, thank you for that. Okay, well, so here's my usual contact information. A note on the slide that I was able to get another essay published in Capitalism magazine, and you can read it there, or you can also read it on Substack. I appreciate your subscriptions to Substack because you can comment, and I appreciate your comments, either whether they're plus or minus, because I always take them constructively, and I think interchange and dialogue are always interesting and most informative to us. And what we're after here is to find out the truth, or as close as we can get to it. Now, I'm going to close by saying, remember, you cannot fool Mother Nature and you cannot fool Mother Market. Francis Bacon, the philosopher, says that nature to be commanded must be obeyed. And it's the same with markets. You can fight the laws of supply and demand and try it all you want, but you can't repeal them with either money printing or price controls or any other form of interference in a natural, voluntary market. All right, thanks very much for listening. And until next time, cheerio.
Just before we finish, we have one more super chat from Mike Sweet. Thank you for your $5. And he says, cheers to keeping cigar prices low. Great show.
Yeah, if I had to pay $20 for cigars, I would definitely cut back. Thank you, Michael.
Okay, that's all.
All right. Don't know what happened to my mouse.